Welcome and thank you for joining today's conference, Department of Market Monitoring 2024 Quarter 4 Market Issues and Performance Report Public Call. This meeting is being recorded. Recording will be available in a few days. All audio lines have been muted until the Q&A portion of the call. To indicate you want to ask a question verbally on WebEx, click the raised hand icon at the bottom of your participant panel. You will hear a beep tone when you are unmuted, and at that time state your name, organization, and question. If you require technical assistance, please send a chat to Inteller Events. With that, I'll turn the call over to Ryan Kurlinski. Please go ahead.
All right, great. Thank you, Stacy. This is Ryan Kurlinski. I'm a manager in the Department of Market Monitoring, and I'll be going over highlights from our recently published Q4 2024 report on market issues and performance. The analysis in this report and the analysis in the slides you're going to see are the work of the entire department. And I'm just the person that gets to present it. Let's see, for questions on this, I'll stop at kind of regular intervals. There's some, I think there's probably some, after some certain sections, I'll stop and take questions. Probably better if you feel comfortable to ask the question verbally. But the way this is set up is it's actually pretty cool. I should be able to see the chat, but I'll try to ignore the chat questions until I get to a kind of a break in the action when I ask for questions from everybody. All right, so that will get going. Make sure I can change the slides. Okay. All right, so this chart shows monthly average natural gas prices at major gas hubs around the West, as well as at the Henry Hub, which serves as a national reference point for natural gas prices. The Henry Hub price was down 14% from Q4 2023, and prices for major delivery points in the West decreased even more substantially when compared to that fourth quarter of 2023. SoCal Citygate was down 50%. PG&E Citygate was down 31%. Northwest Sumas gas prices were down 47% compared to the same quarter last year, and El Paso Permian prices were down 26%. Let's see, but you look at those last 3 months there for 2024, gas prices were up this quarter compared to just the quarter just prior, right? Q3 2024, they're up slightly compared to that. So natural gas prices at PG&E Citygate and SoCal Citygate increased by 24% and 33% respectively, and Henry Hub and Northwest Sumas prices increased about 13% and 40% respectively compared to just that last quarter, Q3 2024. All right. This graph shows the load-weighted average monthly 15-minute market price for each WEIM region. The lower gas prices that we saw on the last slide, those brought electricity prices down with them. 15-minute market prices across the WEIM averaged about $39 per megawatt hour. That was down about 31% compared to the fourth quarter of 2023. That was despite load being about 2% higher on average. We'll take a look at load in a few slides. In this quarter, the California region, right, includes the California ISO. The California region recorded the highest average price at about $45 per megawatt hour, while other regions load-weighted average 15-minute market prices range between $32 and $38 per megawatt hour. The greenhouse gas costs in in California continue to be a significant contributor to the higher prices in California compared to other regions. Okay, this chart shows average 15-minute market prices for the whole quarter, but for each balancing area, right? The overall prices, that's the blue line, the overall price for each balancing area. And the balancing areas are sorted from left to right in descending order of their average 15-minute market prices. Each balancing area's average price, right, is also, we have it decomposed into its components. Those are the colored bars. Some of those components include congestion from constraints in the KISO balancing area, congestion from constraints in other WEIM balancing areas, the greenhouse gas constraint contribution, the system marginal energy price, transmission losses, and congestion from WEIM transfer constraints. So the green bars show greenhouse gas costs for power in California. Let's see, like I mentioned for the last slide, I think these greenhouse gas costs were the main contributor on average across all hours in the quarter to elevating prices in California balancing areas relative to other WEIM balancing areas. We also see significant congestion on WEIM transfer constraints into New Mexico. That's the PNM balancing area there. The congestion on those transfer constraints increased their prices relative to most other non-California balancing areas. And then the yellow bars show the average impact of congestion from flow-based constraints in the KISO balancing area on prices around the West. These internal KISO constraints on average decreased prices in the desert Southwest and Southern California relative to Northern California and the Pacific Northwest. So if you kind of ignored those green bars, the GHG costs, you can see that transmission congestion was on average in a south to north direction over the fourth quarter, again on average across all hours. All right, again, we are looking at load-weighted average WEIM 15-minute market prices for each region. But now the colored lines in this graph are showing each hour's average cost for the fourth quarter for each region, and that's measured on the left axis. The gray bars there show the WEIM system-wide average net load for each hour, and that's measured on the right axis. So we see that most of that average south to north price separation I talked about in the last slide, most of that south to north price separation occurred during the midday solar hours when the KISO balancing area in particular had excess solar that the market delivered to all the other WEI regions, including other balancing areas in California. And that caused congestion on major south to north transmission corridors. So during these solar hours, we see prices in the Pacific Northwest higher than the rest of the WEIM. But then during the non-solar hours, right, the morning and evening hours, those non-solar hours, most of the WEIM region's prices, actually they converge pretty well during those non-solar hours. And the exception is California, right, whose prices are driven higher by GHG costs during those hours. And then bringing in this average system net load, or the gray bars, right? The shape of the 15-minute market prices for California, they're in the blue line, Desert Southwest in the yellow line, and Intermountain West regions in the red line. The shape of their 15-minute market prices, they follow the WEIM system net load shape pretty decently, but we see that the pattern was not so pronounced for prices in the Pacific Northwest, including Powerex. Okay, the yellow and green lines here show the monthly average peak period bilateral power prices at the Mid-Columbia and Palo Verde trading hubs from ICE. The dashed black and gray lines show the monthly average ISO market day-ahead prices at the PG&E and Southern California Edison load nodes. Those average ISO market day-ahead prices, those are for the same hours as the bilateral peak period products, which and I'm pretty sure are hours 7 to 22 on all days, but Sundays and holidays. Those ISO day-ahead market prices, the dashed lines, they follow the trend that I mentioned earlier. Prices were on average lower in the south than in the north for the fourth quarter. And we see this trend across all 3 months, right, October, November, and December. However, day-ahead bilateral prices at Mid-Columbia and Palo Verde, right, they dropped significantly in November and December. Over the last year or more, we had seen bilateral Mid-C prices in particular, right, at or above the ISO market PG&E prices. But starting in November, those average Mid-C prices dropped below PG&E prices. And, the bilateral Palo Verde prices followed those Mid-C prices lower in November and December. The solid black line here is the same bilateral Mid-C price in the last graph. And the light blue line is the same ISO market day-ahead PG&E price. This graph adds the monthly load-weighted average WEIM 15-minute market price for load nodes in balancing areas in the Pacific Northwest. That's the dashed black line. And it also adds the average 15-minute market PG&E price, the dashed light blue line. And again, all those prices are for the same peak period hours for comparison. This chart shows that the Mid-C bilateral prices dropped in November and December relative to ISO market day-ahead prices at PG&E, like we talked about in the last slide. But also dropped relative to ISO market 15-minute prices at PG&E and in the Pacific Northwest. So for most of the last 2 years, right, those monthly Mid-C prices, the solid black line, those have been significantly higher than average peak hour prices in the 15-minute market for the WEIM areas in the Pacific Northwest. That's the dashed black line. And Mid-C prices have been higher than day-ahead and 15-minute market prices at PG&E. However, in November and December, we see those Mid-C prices drop down and converge with WEIM Pacific Northwest prices, and actually being lower than these 15-minute market prices there in November. Looking closely, this convergence actually starts in October, right, when the three prices from ISO markets and those ISO market prices, those went up compared, they went up in October compared to December. Went up in October compared to September. Sorry if I said that wrong. But the Mid-C bilateral prices decreased in October compared to September. and that I think that's in and of itself notable, right? Looking at the last 2 years, Mid-C prices tended to go largely in the same direction as those ISO market prices in the Pacific Northwest and Northern California. This chart now is the equivalent to the last chart for the Southwest. The solid red line is the monthly average day-ahead bilateral price at Palo Verde, and the dashed red line there. It's a comparable WEIM 15-minute market price. It's the load-weighted average of load nodes at balancing areas in the desert Southwest for the 15-minute market, the ISO 50-minute market. And then for comparison, right, this chart includes the ISO market day-ahead and 15-minute market prices at the Southern California Edison load node. Those are the solid yellow and dashed yellow lines. We see bilateral prices at Palo Verde start to converge with 15-minute market prices in desert Southwest balancing areas in October, like we did for Mid-C. Then they converge well, right, in November and December. For me, this doesn't stand out quite as much as the Mid-C prices dropping. However, as we see several periods over the last couple of years where the Palo Verde prices converge to the WEIM Desert Southwest 15-minute market prices. So the conversions of Mid-C prices to the WEIM Pacific Northwest prices in November and December stood out to me as more of an anomaly, but we'll see as we go into this quarter and next quarter. So with that, I think that's probably a good spot to stop and take questions. Next, we'll move on to looking at load conditions. So that kind of ends the segment here on prices. So if anybody has any questions, please go ahead and raise your hand, or what is it, dial pound? I forget what the dial, Stacy. Well, I'm seeing a chat thing too, okay.
To indicate you want to ask a question verbally on WebEx, you want to click the raised hand icon at the bottom of the participant panel. You will hear a beep tone when you are unmuted, and at that time state your name, organization, and question. We do not have any hands raised at the moment.
Okay, all right. I try to bake in 10 to 20 minutes for questions here, so definitely people feel free to ask questions, or I guess ending early isn't a bad thing. All right. All right, so the colored bars here show each WEIM region's hourly average 5-minute market load for the fourth quarter of 2024. They're stacked, right? So the top of the green bar shows the WEIM system average load for each hour of 2024. The dotted black line shows the hourly average system load for the fourth quarter of 2023. So comparing those two, they look pretty close, but system load was up about 2% overall in Q4 2024 compared to Q4 2023. And as noted earlier, the prices across the WEIM were lower, right, despite the higher loads, and that was mainly due to lower natural gas prices. Let's see, so it's not shown on this graph. I just talk about average load for each region. Pacific Northwest average load was about 23.6 gigawatts. That was up 2% from Q4 2023. Average Kitesail balancing area load for the quarter was about 23 gigawatts. That was up 1% from a year earlier. Desert Southwest average load was 14.6 gigawatts. It was up 4%. So we saw the biggest load growth in the Desert Southwest region. Load in the Intermountain West was 9.7 gigawatts, up about 1%. And the non-CAISO California load, the turquoise there, that averaged about 4.5 gigawatts, and that was up 3% from the fourth quarter of 2023. This chart shows the distribution of WEIM system load for the fourth quarter of 2024 in the solid blue line, and it's using we use the 5-minute market load forecast, not the actual final metered load, so we can get the data out in a more timely manner. For comparison, we have the load distribution for the fourth quarter of 2023. That's the dashed line. The area under either of these curves sums up to 1. So if you take the area under any particular load segment, right, that's the proportion of the 5-minute market intervals that have load in that range. So this distribution shows. This distribution rate it's shifted right in the fourth quarter of 2024, right? It should, compared to 2023, right? It shows more instances of high system loads, particularly above about 85 gigawatts in the fourth quarter of 2024 compared to the same quarter of last year, right? The blue line is generally above the gray dashed line over 85 gigawatts, and that means greater frequency of relatively high load intervals. Looking at the lower end of the range, that blue line falls below the dashed line, indicating fewer low load intervals in Q4 2024, and that's especially below about 65 gigawatts. The left half of this table shows each region and balancing areas peak load for the quarter and the date of that peak load. The right half shows each region and balancing area's load during the WEIM overall system peak for the quarter. The WEIM system load for the quarter peaked at 110.5 gigawatts on October 2nd, 2024, earning 18, interval 8 of 12. So this was significantly higher, actually, than the Q4 2023 peak WEIM load, which was about 100 gigawatts, so about 10% higher in Q4 2024 compared to Q4 2023. We can see, again, that left half of the table, all balancing areas in California and the desert Southwest had their quarters load peak during the October 1st to 3rd heat wave, while all balancing areas in the Intermountain West and Pacific Northwest had their peak loads for the quarter between December 2nd and December 16th. Then, note by looking at the right half and comparing to the left half of the table, that the loads of most areas in the Pacific Northwest and Intermountain West during the system peak on October 2nd, right, you can see that on the right half of the table, their loads during that system peak on October 2nd were substantially below their peak loads for the quarter. So this load peaking diversity between the regions helped the overall WEIM system get through the early October heat wave in California and the Southwest. All right, so that's it for load. We'll move on to supply. So let's stop here again for questions. Anybody have any questions? I'll try to check the chat. Okay, we got to. Someone asked me to repeat. How much did I say CAISO was up? Guessing that refers to load. Let me go 1 second. Let's see. CAISO balancing area load was up 1% from a year earlier. Hope that answers that question that I got in the chat. Do we have any other questions from anybody?
We do not have any hands raised in the queue.
Okay. And then I'll go on here to supply. All right, so first we'll go over changes in supply in the various WEIM regions from the fourth quarter of 2023 to the fourth quarter of 2024. So in these next 4 charts, we'll look at one chart for each region. Positive values show an increase in the fuel type compared to Q4 2023, while negative values show a decrease in the fuel type. And the black line shows the hourly average increase or decrease in load, or positive is an increase in load. All right, here looking at the Desert Southwest. In the Desert Southwest, wind was up across all hours and coal was down. Net dynamic WEIM transfers, those are the pink bars, those increased in the direction into the Desert Southwest in morning and evening hours, while net imports, and those are net imports like excluding WEIM dynamic transfers, so it's kind of like the hourly block imports and exports in each balancing area. Those are the red bars. Those net imports decreased in most hours. Solar and hybrid production increased significantly during midday solar hours. We see battery charging also increasing significantly during solar hours, and battery discharging increasing significantly during the evening hours. I think it's an interesting thing to look at here is the battery discharge also increasing significantly in hours 6 and 7. Yeah, right. That's right before the solar production begins. In California balancing areas, this includes CAISO now in this grouping. Net imports, that's the red bars. Again, those are mainly the hourly block imports. Again, it's the net though. So the net imports and the net WEIM transfers into balancing areas, that's the pink bars, those increased in all hours, as did nuclear production, wind, and coal. Natural gas production was down significantly across all hours. And similar to the Desert Southwest, right, there we see large increases in the solar and hybrid production and battery charging during midday solar hours. And we see large increases in battery discharge during evening hours. And again, as we kind of get more batteries in the system, and the system starts to rely more on batteries, less on fossil fuel powered resources to get through the middle of the night. It's interesting here to see that uptick in net battery discharge as you get into late in the night, right? Hour 23, 24, then going into hours 1 and 2 even, and then also hours 6 and 7, we see that uptick in battery discharge before solar production begins. All right, the Intermountain West region had significant reductions in coal production and net imports into the region across all hours. There were large increases in wind production across all hours, increases in solar during solar hours, and increases in natural gas production during the non-solar hours. And then finally here, the Pacific Northwest. there, whereas we see a large increase in hydro production across all hours, as well as increased wind production. It's kind of led to net imports and net WEIM transfers into the region decreasing substantially in each of the 24 hours, as did natural gas production. You know, I think that makes sense, right? Increased hydro production in the Northwest is going to result in them having less power flowing in, more power flowing out, or, you know, it's the net imports going in the direction from coming in to instead changing to going out relative to the same quarter of last year. Okay, we added a new chart for each region in this quarter's report to try to give some more information on, you know, imports and exports and WM transfers, how those kind of change year over year and quarter by quarter. So, you know, these graphs have a lot of detail. So, you know, if you look at it, it may take some time to look at it to get some stuff out of it. But if you look at these graphs carefully, I think you can see a lot about the different types of imports and exports and transfers. So this focus today on the Pacific Northwest. I won't go through all these graphs like I did the change in supply. Pacific Northwest, right, like you saw on the last chart, that had that large decrease in net imports each hour, year over year this quarter. And that shows up on this graph by comparing, so that, you know, there's kind of 8 different charts here. So that decrease in those net imports shows up on this graph by comparing the dotted line in the right chart to the dotted line in the chart just to its left. Right, those are the interchange before dynamic transfers, right? So those net kind of hourly, those net hourly block-based imports. That's what that dotted line is. That's kind of comparable to the dark red bars in the previous chart. Now we break imports and exports up into 2 different categories. So base WEIM exports. I'll just talk about exports here. Base WEIM exports, those are the light yellow bars. Those are hourly block base exports out of the region, right? So those are the kind of the hourly block exports that are on the same transmission between WEIM areas that dynamic transfers go up and down on. We are differentiating those from base non-WEIM exports. Those are the dark yellow bars. These are similarly hourly block base exports, but they are not tagged on transmission flowing directly through to a WEIM area. Many of these base non-WEIM exports end up as import schedules into the CAISO balancing area over the CAISO BA intertie constraints, the ITC scheduling constraints that CAISO has. So just something, you know, to kind of note from this graph, you can, right, you know, for this quarter, right, there was the decrease in net imports we talked about compared to the fourth quarter of 2023. That was despite a reduction in exports during most hours. But this chart shows that the shift down in imports is larger than the reduction in exports. You get a reduction in net, overall reduction in net imports. Okay, so now, you know, we're also putting graphs in to dive into some more detail on the dynamic WEIM transfers. And again, we're trying to differentiate more between, right, imports, exports that are optimized in the market, right, in the WEIM market, versus just the kind of the hourly block kind of base imports and exports. So this graph shows the net flows of WEIM transfers between regions for each hour of the fourth quarter of 2024. And I do apologize here. We have exports showing up as positive here, imports showing up as negative. That is the reverse of the previous several graphs. You got to kind of change your mindset here from what you were just looking at from the last like 5 graphs or so. And in one of these quarters, we are going to get the import-export sign convention to be the same across all of our charts. All right, so this chart shows that during midday hours, the CAISO balancing area was the dominant exporter of WEIM transfers, you know, transferring power to the other regions, including non-CAISO California balancing areas, that's dark blue, They're sending power to the Pacific Northwest, that's the green bars, Intermountain West, the yellow bars, and the Desert Southwest in the red bars. In the peak evening hours, WEIM transfers were mainly from the Desert Southwest and Intermountain West to CAISO, and also to other California balancing areas. We see in hour ending 23, 24, then in the morning there on the other side there, hour ending 1 to 5, the Pacific Northwest became a relatively significant importer of transfers from the Desert Southwest and Intermountain West regions. So quarterly reports now. We've also added outage charts for each WEIM region and try to provide some more insight into outage trends across the WEIM. This chart shows for balancing areas in the Intermountain West region. It shows each quarter's average of each day's maximum generation outages during peak hours, and they're categorized here by outage type. Planned outages are in green and yellow bars, while forced outages are shown in blue and red bars. We see that in the Intermountain West, forced outages were up significantly in the fourth quarter of 2024 compared to the fourth quarter of 2023. While planned maintenance outages were down even more, resulting in a slight overall decrease in outages in the region. We also added charts that show outages for each region, but by fuel type. So this should be the same outages as the last slide, but showing by fuel type instead of outage type. Something to note here, it's compared to the fourth quarter of 2023, hydro and coal outages in the Intermountain West were down slightly, while natural gas outages were up slightly. And then in this report, we also added some coverage of available balancing capacity in WEIM areas. Available balancing capacity is a sort of reserve product for WEIM areas. That'll get added as potential supply for a balancing area in the ISO's optimization if the balancing area would otherwise have a power balance constraint violation from either too little or too much supply relative to the load forecast. This table here shows the percent of hours that each balancing area offered upward and downward available balancing capacity, and then it shows the average megawatt offered during hours that any megawatts were offered. So not shown in this table, but another I think relevant fact here we put in the report. That's the available balancing capacity ended up being dispatched in less than 1% of intervals for all areas, except for NV Energy, which had both products dispatched in 3% of intervals in the 15-minute and 5-minute markets. All right, so that's another good place to stop for questions. See if we have any questions. We'll move on to operator interventions next.
We do not have any hands raised.
All right, keep ranking then. All right, so we're moving on to operator interventions. So here we're looking at the average hourly load adjustments that balancing areas in the Intermountain West make to the load forecast in the 15-minute market on the left and in the 5-minute market on the right. This is for the fourth quarter of 2024. And the adjustments are shown as a percentage of the balancing area's average load over the quarter. We'll see on this in the next couple of slides that most balancing areas make significant adjustments to the load forecast in the 5-minute market. Those are the graphs on the right. We do not see most balancing areas making substantial adjustments to their 15-minute market load forecasts. Right, so if we look at the graph on the left here, we're seeing right Avista making some minor average downward adjustments to its 15-minute market load forecast. So one notable exception, one of the two kind of notable exceptions to the trend of low 15-minute market load adjustments is BPA, Bonneville Power Administration. You see them making average adjustments of close to 1% of their load during late morning and evening hours in both the 15-minute market and 5-minute markets. And of course, the other notable exception, right, is the CAISO balancing area, which, as we've been reporting on for many years now, right, they make much larger manual adjustments to their load in the 15-minute market than in the 5-minute market, especially during those evening peak net load hours. And they do that in order to help position resources to address uncertainty in load and supply in those evening ramping hours. Another thing we've added to our quarterly report coverage here is the coverage of manual dispatches by operators in balancing areas in WEIM regions. This chart shows by quarter the average hourly manual dispatch energy in the Pacific Northwest. That's broken out into incremental manual dispatches, which are shown as positive, and decremental manual dispatches, which are shown as negative. The chart also shows that the dispatches were to participating or non-participating resources. Similar to exceptional dispatch energy in the CAISO balancing area, which we've been reporting on since MRT go back in 2009, similar to the exceptional dispatch energy, the manual dispatch energy in the WEIM regions is a really small percentage of overall supply. For the fourth quarter of 2024, the combined incremental and decremental manual dispatch energy in the Pacific Northwest region decreased by 12% compared to the fourth quarter of 2023. Then not shown here, just mention here that the manual dispatch energy in the other regions increased a little bit. The Desert Southwest overall, combined manual dispatch energy increased by 36%. In non-CAISO California balancing areas, the manual dispatch energy increased by 27%. And in the Intermountain West region, it increased by 13%. All right. So the CAISO balancing area uses adjustments to the residual unit commitment market load forecast in order to procure extra capacity to cover uncertainty between what the day-ahead net load forecast is and what the actual net load may end up being in real time. It looks at system conditions to determine if it thinks it needs capacity to cover no uncertainty, the 25th percentile of potential realized uncertainty, if it needs capacity to cover the 50th percentile of uncertainty, the 75th percentile of uncertainty, or the 97.5th percentile of uncertainty in the day-ahead net load forecast that may materialize by real time. This graph here shows the average RUC adjustments the CAISO balancing area made each day over the peak morning and evening hours from May 7th to December 31st, 2024. And a color coding shows DMM's estimate of which percentile of uncertainty the adjustment was intended to try to cover. During the fourth quarter, CAISO attempted to procure capacity to cover the 97.5th percentile of potential net load uncertainty on only 3% of days. You see that red shown up there in early October, only 3% of days in the fourth quarter. CAISO targeted the 75th percentile on 9% of days, and the 50th percentile on 34% of days. So during much of the quarter, right, on 54% of days, no adjustment to the RUC load was applied in order to procure capacity to cover uncertainty. The percentile of uncertainty that CAISO is aiming to cover with the RUC adjustment has implications for the extended day-ahead market's imbalance reserve product demand curve. This is something we've talked about in reports and on these calls for several calls now. And that's because, right, the RUC adjustment is meant to procure capacity to cover the same net load uncertainty that the imbalance reserve up product is intended to cover. Right? However, the imbalance reserve up product demand curve is designed to pay $25 per megawatt hour to get capacity to cover the 97.5th percentile of uncertainty in all hours of all days. And as you can see from the CAISO's use of the RUC adjustment in the fourth quarter, CAISO rarely needs to procure capacity to cover the 97.5th percentile of uncertainty. On most hours of most days, right, the CAISO balancing area relies on capacity that does not have an IFM or RUC award to show up in real time to meet most net load uncertainty that might materialize. So the point is that the low number of hours in which the CAISO used that 97.5th percentile target in RUC indicates that the imbalance reserve product demand curve may be much too high during most hours. That, I'll stop again for questions, just to have two more substantive slides. Any questions on manual dispatch or anything before that?
We don't have any hands raised in the queue.
Okay. Wow, amazing. Get through this with no questions. Okay. Go to the next slide. All right, this graph shows quarterly congestion revenue right auction revenues received by transmission ratepayers. That's the blue bars. And shows payments made to those auctioned CRRs based on day-ahead market congestion rents. That's the green bars. When auction revenues received by ratepayers are less than the payments made out to those auction CRRs, transmission ratepayers lose money from the CRR auction process. And those net losses are shown by the gold line. The fourth quarter 2024, transmission ratepayers lost about $1.7 million from the CRR auction design. In the fourth quarter, DMM, we released a white paper on an auction design that would not include the sale of a large number of CRRs offered at a $0 reservation price, but that would instead only have CRRs for sale that were willingly offered by load-serving entities and financial entities at a reservation price that they were comfortable offering at. So yeah, I also want to note here, DMM's critique in that paper, and overall, is of the CRR auction design, not congestion revenue rights themselves, right? And we think congestion revenue rights can be an effective way to allocate day-ahead market congestion rent. But any auction of additional financial instruments after the CRR allocation process should only include CRRs that willing sellers offer into the auction. All right, go to my last substantive slide here.
I have one hand that's gone up.
Oh, there we go.
Would you like to take that question now?
Yeah, please.
Okay.
Hi, sorry, this is Jordan Meyer from the CPUC Energy Division. I do have a question on the CRR slide because I've been following CRRs. Does DMM have a sense of how much ratepayers lost in 2024 overall? And does DMM have a sense of what market participants made money in Q2, Q3, and Q4? I just want to understand if I understand that the values of losses are a lot less last year, but are the same entities making the money as previous years, just less so?
Yeah, so that gold bar here, I'm not sure if you can see my pointer. You see the gold bar? That
Yeah.
shows total ratepayer losses for all this previous quarters going back into 2020. So Q3 and Q4 losses were low, and in fact Q3 there were slight gains actually overall from for the ratepayers in the auction. The losses in Q1 were very large. I don't have the exact number. You can just read from the chart. Over $50 million, and then it looks like just maybe around $15 million of losses in Q2. So again, just eyeballing the gold bar from the chart, I'd say the losses, on around $70 million, $60 to $70 million for the year. And again, I haven't added those numbers up in this eyeball and the gold bar in the chart there for 2024.
Okay, yeah, 70 sounds reasonable looking at this line. Thank you. And then in terms of market participants, in Q2, where we saw ratepayer losses, are those the same market participants winning in other quarters or making money in other quarters?
Which quarter?
Q2. I'm trying to understand.
Yeah, I'd have to go back to
entities. Yeah.
Yeah. So actually, our quarterly reports we break out the losses by entity type. I don't have that pulled up in front of me at this point, but I'll definitely refer you to the congestion revenue rate section of each of those quarterly reports, including the Q2 report. I mean, we do break out the profits that each entity type made, which would which would be kind of the losses to non-load serving entities.
Thank you, Ryan. That's helpful.
From source groups. Okay. Yep.
Thank you.
Any other questions? Well, thank you for the question. Nice. Good to get one. Nice to get one question here. All right. I'll go on to the last slide now. Okay. So this table shows the 5 hours in the fourth quarter of 2024, in which CAISO balancing area resource adequacy capacity available in real time was not sufficient to meet the CAISO's 5-minute market load forecast, plus losses, plus upward ancillary service requirements. The available resource adequacy capacity, that's the bid-in resource adequacy capacity in real time from RA resources not on outage, including all of the 5-minute market forecasted energy from resource adequacy contracted variable energy resources. All 5 hours occurred during hour ending 19 between October 1st and October 7th. I definitely need to note here that the non-dynamic resources, such as non-resource specific import resource adequacy resources, those types of resources, they don't have a real-time must-offer obligation if they do not receive an award in the day-ahead markets, right, in ISM or RUC. So some of the shortfall is definitely due to non-resource adequacy capacity displacing some resource adequacy capacity, right, which maybe showed up in day-ahead but didn't have an obligation in real time. We do plan on further refining this metric to try to get to something that that maybe can really indicate when there may have been an actual shortfall in resource adequacy capacity in the day-ahead and real-time markets, for meeting the balancing areas requirements in real time. But I think this is still an interesting metric, but it's not quite all the way there. So with that, let me go to the last slide. Any final questions for anybody?
We don't have any hands raised.
Okay. So with that, let me, for more information, please head to our webpage here. The link is here on these slides. This quarterly report is there with more information on the things I talked about here today, and along with lots of other good information. And please, we love to meet with people offline. If you have questions, any questions about market performance, market design, please reach out to DMM. You have my email address there. There's other contact information on the website, and also email that DMM address there. That'll get to Latos and DMM in case I am slow at returning emails, which happens sometimes. But I really want to thank everybody for listening. I appreciate your time. Look forward to talking to people about the annual report coverage and the Q1 report coverage in the months to come. So thanks again, everybody. Appreciate it.
That concludes our conference. You may now disconnect.